Good morning, everyone. Welcome to the Audit Committee of CalHFA for October 26th. Apologies for getting started late, but we will catch up during the meeting. Melissa, am I ready to go?
Yes.
Wonderful. My name is Delilah Sotelo. I'm the chair of the CalHFA Audit Committee, and I would like to go ahead and introduce the other members of the committee. I believe we have standing in for Treasurer Fiona Ma. We have Patrick Henning. Hello, Patrick. And then we also have CalHFA board member Fred White on with us. And of course, it's always nice to see you, Miss Johnson Hall. So looking lovely today.
Thank you so much, Committee Chair Sotelo. It's great to see you.
Thank you. So with that, let's go ahead, Melissa, and do roll call to establish a quorum.
Certainly. Mr. Henning for Treasurer Ma.
Here.
Mr. White.
Here.
Ms.
Here.
Sotelo.
Here.
Thank you. And thank you, Chair Sotelo. We do have a quorum.
Wonderful. Thank you very much, Melissa. So with that, item number 2 is the approval of our minutes from the November 17th, 2022 meeting. Does anyone on the committee have any changes or comments to the minutes?
None for me, Delilah.
Okay. Do I hear a motion to approve the meeting minutes?
Motion to approve.
Wonderful. Thank you. Let's go ahead and approve those minutes by consensus with no objection. Wonderful. So with that, I just wanted to make some opening remarks. Again, thank you for the team led by Ms. Johnson Hall. You guys always do a wonderful job of informing the board and being diligent on the audits and making sure that you're working collaboratively with other departments of the state. I really do appreciate all the help that you provide the board and guidance, and what a wonderful job you guys do. In today's agenda, it includes the report of the audit year ending June of 2022. We have 2 guests with us today who are going to lead us through the presentation. The second item today is also going to be the presentation of our SLAY report. So we'll be hearing from staff about that and Rebecca about that. And then we're looking forward to our next November 30th audit committee, in which we're going to be doing a little bit of a deeper dive on the information security updates. So there's a lot of information to cover today. So let's go ahead and get started. If that's all right, Mr. White and Mr. Henning. Okay, so with that, we have Oskana from CalHFA. She's our comptroller. She's here to introduce this year's update, introduce our guest, Mandy. As always, we're always nice to see. It's always nice to see you, Mandy. And then we have Clifton Larson Allen joining Mandy. So, oh, I'm sorry. I think we have, Liz Richardson from Clifton Larson Allen joining Mandy. So with that, I'm going to go ahead and turn it over to you, Oksana.
Thank you, Delilah. Good morning, Madam Chair Sotelo and members of the Audit Committee. My name is Oksana Glushenko, and I'm the agency comptroller. Today, I'm here to discuss the results of fiscal year 21-22 financial audit. We also have the principal, Mandy Merchant, accompanied by the senior associate, Elizabeth Richardson of Clifton Larson Allen. It has been another challenging year in terms of operating under COVID, but I'm pleased to inform you that the COVID did not cause any impact on the financial position of the agency. One thing to note, we are still struggling with producing timely and audited financials due to not receiving the pertinent information from one of our control agencies. We are working with our colleagues at the State Controller's Office as they provide the proportionate share of pension and post-employment benefits. My team and I are committed to improve the timeliness of financial reporting, as I recognize the impact to external and internal stakeholders that rely on receiving this information. In addition, State Controller's Office has informed us in their pursuit of a new process for the audit for the OPEB, post-employment benefit information, which should allow timely submission of our audited financials for fiscal year 23-24. Lastly, I want to thank all CalHFA staff who help us to prepare the audited financials and our Clifton Lawson Allen team for their guidance and diligence in completing this year's audit. Without further ado, I would like to give a floor to Mandy and Liz as they make our financial presentation. Thank you.
Thank you, Oksana, and good morning, everyone. Good afternoon for us. We're out here on the East Coast, but it's great to see a lot of familiar faces. I'll wait for our presentation to be pulled up and we'll get started. So I'm assuming everyone on the call has received a copy of the final issued audit financial statement. So Liz and I are not going to go through it in detail, but we are just going to kind of go through and highlight some information throughout the report that we think is important for everyone on this call, and especially the audit committee members. So this slide and the next slide, just really quick high level. I know Delilah knows us, but for the other two committee members that don't know Clifton Larson Allen, you know, we are the 8th largest CPA firm in the United States. We do a lot of work with HFAs. We work with about 13 HFAs across the country. We also have a large presence in California also. So I think that's probably the two biggest important things to know about CLA, because it has to, you know, it has to do with you all. If you kind of skip 2 slides, yeah, that's just to kind of see where we are. Okay, engagement team. This year we did, last year we did come on site and work out with the staff. Myself, Liz Richardson, Mike Seafick, Taylor, Evan, and Dan are all part of this team. A couple of us came on site last year to continue with the audit field work, and then some people weren't there, but they were behind the scenes wrapping up information. What's important about this is that me and Liz have been working on this engagement since the inception, so we have a lot of institutional knowledge, which helps you know, get this audit to the finish line. So we understand there's delays that go on with you guys with the state, but it's nice to have a consistency year after year to get this audit done when everything is ready to go. Next slide, please. Okay, so just a couple of things. So your annual comprehensive financial report, or as we refer to it as the ACFR, has a lot of information in it, a lot of good information about the agency. So this is just highlighting everything that's in there as part of that booklet if you didn't get a chance to fully go through it yet. But the key things we're going to talk about today, we are going to talk about the management discussion and analysis and talk a little bit about the financial statements and footnotes. You guys should have this. This is also up on your website if you ever want to grab it and take a look at it. All right, well, let's dive into the numbers. Let's go to the next slide. So a lot of numbers on here, but what we like to do is kind of just show you guys a comparison of the results of the agency from the past 3 years on the statement of net position or the balance sheet. So a couple of the key things I want to point out here is that we're going to kind of look at the changes. We're going to look at the increases and decreases that have occurred from 2022 to 2021. And, you know, as part of our audit approach, which is a risk approach, you know, we kind of come into the agency, you know, use our historical knowledge and talk to management and kind of, you know, have expectations of what's going to occur based on discussions, you know, depending on what, you know, the strategic vision of the agency has been for any given year and what's occurred, kind of looking back on it. So as you can see on here, there's a lot of increases in assets, you know, current assets, and some decreases in non-current. And let's go to the next slide. And you can see here, looking at the liabilities, you kind of see a kind of similar change. So on here, you're kind of seeing some changes in the current and the non-current liabilities from the current year to the prior year. So we'll go to the next slide, and this is where we're going to kind of take a dive into those changes. And you can see for the first one, we're going to talk about cash and investments. So cash and investments increased $57 million, which is great. You know, everyone always likes to see cash increase. And that's increases in your SMIF, your investments. And a lot of that has to do with, you know, rate increases and, you know, more money coming in the door and being in these investments and earning some interest on them. In addition, you know, program loans receivable decreased during the year, and that's primarily related to principal payments coming in versus, you know, not as much new loans going out the door. So that activity, you kind of see that when you see that decrease, it means that you guys aren't, giving out as much right now, but you have a lot of payments coming in the door and paying down those balances, which is what we want to see. Bonds payable, and Liz will get into this a little bit more a little bit later, but we did continue to see a decrease in the bonds payable. And that's basically due to normal, reoccurring annual payments and also the early redemptions that the agency has been actively doing over the past couple of years. Couple things about the other non-current liabilities. The net pension, even though the state was late in giving you the pension and OPEB information, luckily your liability did go down. So that's good to know. So there was a decrease in those two amounts, a $16 million decrease in the pension liability as of the year end, the same thing with the OPEB. The swaps did go down $45 million, and that is kind of attributed to things. I know you guys have been paying off some swaps during 2022. And also due to the fair value adjustment that's occurred more in the favor of the agency. And then lastly, the national mortgage settlement. Last year, you guys have received a lot more lot more money last year versus the prior year. Does anyone have any questions on any of those changes? Actually, my mistake. You received more money this year in the national mortgage settlement. Excuse me. I was thinking of another program. Okay, let's go to the next page.
Mandy, and I want to make sure that I'm abundant. Is this because I keep seeing 2022?
Yes.
This is 2022, fiscal year 2021, 2022, correct?
Yeah. So yes.
Okay, so we're like 2 years back.
But yeah, in theory, yes.
Okay, thank you.
And I don't know, Oksana, if you want to give the dates. I don't have them right in my hands, but when did we receive that report from the state? So our 6/30/22 numbers from the report from the state didn't come until when again?
So basically, we received two different reports. So state of California provided an allocation to proportionate share because our agency is component unit of the state. And so we received two reports. The pension report was received late spring, but the OPEB, the post-employment benefit, that's the report that we've been waiting for. It didn't get received till August. And Mandy and her team had literally 2 months to wrap everything else. And then we were competing with other customers that have ongoing audits as well. So that's the timeline.
Yeah.
And then, but Mandy, I'm just trying to make sure that I'm clear. This is my first time on the audit committee here, so forgive me. But when I'm looking at even the slide in front of me, when it says 2022, that's only for half the year.
No, it's a full year. So there's 7/1 to 6/30 of 22. So 7/1 of 21 to 6/30 of 22. They're a fiscal year end. They're done.
Okay. It's just it goes from 2022, 2021, 2020, and then the percentage change, and the percentage change, those look like fiscal years and the other ones look like full years.
Yeah. No, they're all the fiscal years. They're not on the calendar year. So
okay. It's all fiscal. All right.
Yeah, we just want to make sure you understand why we're so late. It is because of those delays. So
And
why
I
you're
believe it's
old data.
and Oksana, is that the controller's office on that last report?
Yes, that's correct. It's been a couple of years, but like I spoke earlier about this, they're just making improvements, and they recognize that this has been an ongoing issues. And so there's not just only on our agency, there's a lot of other agencies that's been impacted with not having this numbers.
We're aware of the issues with the controller's office, and you're being very generous. Appreciate you.
Thank you.
Okay, guys. All right. So now we're going to look at the statement of revenue, expenses, and change in net position, or the income statement. So again, this is the activity, kind of again looking at each year, kind of seeing the operations, and you kind of see just even looking at the top line, looking at the revenues, seeing kind of, obviously there was a lot more programs coming in, the market was doing better in prior years. You kind of see that kind of that change that kind of has occurred over the years, and then kind of coming down to the bottom line, kind of coming down to the increase, decrease in that position. You can see that this year you guys actually had a decrease in that position. So as compared to the prior years, but a lot of that is just dependent on the money coming in the door for the different programs. and what's being spent. So it all is just part of that kind of equation. So let's go to the next page, and we do have some highlights here just to kind of go through on that. So again, just as we were mentioning, kind of like seeing the investments go down, a decrease in that realized gain on the securities. And it's just, the volume, the TBA market, just kind of a decrease from the prior year. Overall, there was some control in the expenses, so having a decrease in the overall expenses during the year. You can see the reversal of the provision for loan losses. And if everyone just remembers that, that just means that, we have each year the agency looks at their loans and decides, hey, are we going to be able to collect all this? Are we going to have some troubled loans? And the agency decide that, hey, you know what, we don't need this much reserves. Things are going good. So they reversed that. So they actually brought in a credit. Also some decrease in some service release fees, counseling fees, some discretionary expenses. So kind of a decrease across everything in the expense line. We also had a increase in the amounts due to the investment in swap revenue. Again, that is also kind of, correlates to the change in the swaps. As the swaps go down, we will see this amount increase. And then lastly is the decrease in the transfers out. So last year there was a much larger transfer out related to the low and moderate income housing program. So, any questions on this one? I know it's a lot of information, but I promise there's a lot more we could throw at you, but we take the highlight.
Mandy, can you tell me a little bit about the 28 million reversal of the provisions for loan losses? Explain that a little bit.
Yeah, so Oksana, chime in if you want to chime in too. But again, without having the details at my fingertips, that would be that. So last year, your loan loss was about, $50 million based on the amount of loans you had outstanding, and management this year decided, hey, that was too much. So you're being probably too conservative. And when you look at that, you look at historically, like what has happened historically at the agency. Like, do you have a lot of losses on loans? So do you have a lot of loans going bad? But you're not having loans go bad. So then management decided to reduce that allowance from 50 million to now 25 million. So Oksana, I don't know if you want to add any kind of flavor to that.
Yeah, Mandy, absolutely accurate. So with us redeeming bonds, and then for the rates being low for the last couple of years, we have received a tremendous amount of repayments and prepayments. So our single family loan portfolio, we just have a very small legacy, maybe $500 million left. And so this loan's being reduced. So, and then the rest of the portfolio is pretty healthy for the, past year, how many years since the last crash of 2006. So we had to make adjustment and reduce based on the performance, what Mandy earlier stated, and just the portfolio overall being reduced, plus the portfolio being healthy. So that's two main contributing factors to that number being sort of large. For this.
And Oksana, when do we actually figure out the actual losses?
We make assessment. So we receive performance reports from all the servicers. And so this is just the work that us and the financing division, we constantly make assessment. And so as we produce financial quarterly, the adjustments are being done. So there's just the quarter to quarter, you may see the adjustment. So if you would even just look at the prior months or prior quarter statements, so we will make adjustment as we go on, and we recognize that if portfolio is either healthy or the portfolio is getting in, if there's more foreclosures or things going on in the market become volatile and we need to make adjustments, we are being really proactive in that manner and just make adjustment as we go.
Okay, I just wanted the committee to note that this is, at the height of the COVID pandemic. So, in terms of noting loan losses, it's just something to be mindful of given the pandemic period. Thank you very much.
Surprisingly, the pandemic didn't really affect the portfolio. I think a lot of loans that we carry are very loans that we purchased back in like 2004 and early 2000s. So the principal balances, so the people been living in those houses for a while, so they have a lower
Yeah.
principal and probably more paying principal than interest. And so we didn't really have any foreclosure or any issues during the pandemic on that specific
Yeah.
portfolio. And as of 2006, I just wanted the members of the committee to note, we haven't purchased a first mortgage portfolios. We only participate in the TBA market. So this is just a legacy portfolio that we kept. And the last loan is probably predates 2004, 2005.
So none of these are the multifamily product. These are all single family.
Yeah,
single
and then
family
we also
product.
do multifamily assessment, but on the multifamily, we haven't really had any projects. There's just been a few couple strugglers here and there, but majority of the loan portfolio, nobody really missed the payment, and we haven't foreclosed on any multifamily loans at all.
Great, thanks.
Great question. Okay, well, we are gonna kick it and look at the comparative analytics right now, something we do every year. I'm gonna turn it over to Liz, and she's gonna kind of go through these graphs that we put together.
Yeah, so we just like to show the 5-year comparison, just, to give everyone kind of a bigger picture of where some of these big balances stand. And again, each of these is showing everything in terms of a fiscal year. So it would be fiscal year 2018 through fiscal year 2022. So as you can see, the derivative swap liability decreased significantly during FY22. And, you guys have been actively trying to terminate those swaps. And I know as of FY23, you actually have none left. So it's just going to continue in that downward trend. And then bonds payable, that one also decreased this year, which, as we expected, you guys have kind of been out of the bond market for a little while, and you've been actively trying to terminate those early. So nothing out of the ordinary. And then if you want to go to the next slide, program loans receivable, those stayed pretty consistent. As Mandy mentioned earlier, there was a slight decrease in the number of loans issued during the year. And then that combined with regular principal payments made by the borrowers, just saw a slight decrease during fiscal year 22.
I did want to chime in for a minute. I was out at NCSHRA, and they were giving out awards to all the different HFAs. I told this to Tina, and they would give clues that they would make the announcement. And when I heard the agency that paid off all their swaps, I'm like, CalHFA. It's like I was winning a trivia contest, and I saw you all cheering and standing up. So congratulations. It was a nice story to put out there.
So then moving on to the single audit report, this is also included in that ACPR that you all received. But we tested one program as major this year, and that was the Homeownership Assistance Fund, or I think as you all refer to it as the Mortgage Relief Program. And we're happy to announce we did not have any findings. So great job to the team for this new program this year, no issues. And we also had no financial statement findings.
Okay. All right. So then as we kind of wrap up the audit, there was an additional letter you all received that is our auditor's communication. It is a required communication to those charged to governance, which would be this committee, just kind of summarizing the results and anything, that we became aware of. And then just kind of reading through this really quickly, we did not encounter any difficulties in performing the audit. We did not put in delays of the state, but besides that, there were no difficulties. There was no corrected or uncorrected misstatements, and what that means is that we didn't have any audit adjustments of a material nature that had to be made. Management gave us their trial balance. Management gave us their draft of financials, and we tied that out to supporting documentation and did not have any issues. Uncorrected misstatements are differences that arise that don't kind of get to the level of needing adjustment, but we did not come across any of those either. So that is very commendable to the finance staff that they're able to go through entire audit and not have any adjustments that an auditor makes. So no disagreements with management. We did have a management representation letter that was signed by all parties. And then lastly, we were not aware of any other consultations by management with other auditors. So if anyone has any questions on that before we get through a couple other things. Okay, well, let's go to the next slide. So just a couple quick things. Each year, there's always possibly a requirement for us to implement new auditing standards. And this year there was 2 new ones that we did implement. We did implement GASB 87 related to leases, and then also GASB 91 related to conduit debt. So we did record a right to use asset for the building on the books, and then the related liability associated with that. And then the conduit debt one was just some changes in the footnote disclosures. All right, so let's go to the next slide. What exciting auditing standards are coming in the future? So we got 3 coming. Really, the first one is, I think the only one that's really going to impact you all for this year, for 2023, and that is the, as they call it, the subida. So it's just like the leases, except so in the leases, it's scoped out anything about information technology. So leases was things you could touch, you know, that you could put your hands on. 96 is all the subscriptions that you guys have with companies. So like your accounting software, Microsoft, any other thing that you guys use, you subscribe to, you pay a monthly, annual kind of fee, needs to be considered. So I know your IT department's got a lot going on there. So this will be a heavy lift or a heavy, you know, kind of discussion with the IT department to see what kind of information is out there, any of these subidas that need to be considered to be recorded for this year. So Oksana, I don't know, have you guys done much with this yet? Have you started looking into this? Anything come about?
For the GASB 96?
Yeah, for 96.
We are gathering information. When you arrive within a week, we will have all the files and contracts and everything ready. So I've been working with IT department for the last couple of weeks, as soon as we were informed that you guys will need to pull every single contract. So like you said, everybody's been busy just gathering and collecting all the documentation and preparation for your arrival.
Thank you. See how easy they make it for us? So that what might happen is once we review this information, again, you might see an asset being recorded on the books because, you know, you're using that in a form that you have control. So there would be an asset recorded in the related liability. Does anyone have any questions on that?
Mandy, I did. Is this something that is fairly new? Can you cite some examples of what you might be looking at in terms of?
Yeah, so it would be, oh God, off the top of my head. What do you guys have, JD Edwards? What accounting software?
Mandy, to be honest with you, I didn't want to go into the further discussion, but since Tina asked, I'll answer the question. So
Okay.
basically, the way how it applied the subscription-based GASB pronouncement. So if you have a short-term or cancelable type of agreements, they're not subject to that GASB pronouncement. So we're hoping that all of our agreements are, well, we're not hoping, we have actually terms and conditions that we can demonstrate to the auditors, but based on our assessment so far, all of our agreements are cancelable. So we don't anticipate that's going to be any impact for our agency. We are not heavy or big on a lot of subscription. We do have a, handful, of course, everybody's using technology nowadays, but we don't anticipate really a big impact on the agency. And we're preparing documentation that support whether the GASB apply or doesn't apply. So we let the auditors to look and determine if the documentation that we are prepared are sufficient for the implementation.
I think they thought, like GASB thought there was gonna be a lot more out there, but there isn't. So it's been actually a pretty easy standard to implement. So most technology companies don't want to lock in 3 to 5 year contracts. They want increased rates every year. So that's what they're smart. So that's what we're seeing right now. So most of them are a year. So that's all we have. Just as always, thank you to everyone at CalHFA. We have we appreciate the relationship we've developed over the years working with you all. So I think each year, we get smarter and better. And it's great to work with you. So if you guys have any questions, just let us know now, or I'll be on later too.
Great. Thank you so much, Mandy and Liz, for your report. We really appreciate it. Can you hover on page 21 just for a moment? And I'm going to turn it to Patrick or to Fred if you have anything else. Any other questions?
Good.
No other questions. Thank you for the presentation, Mandy. It's very, very thorough. Appreciate it.
You're welcome.
Yes, that's the page I wanted. Patrick, do you have any other questions?
No.
Okay. Wonderful. I just wanted to, end the presentation, Mandy, with this page just showing, how wonderful and stellar the team has done. No difficulties encountered during the audit, no corrected or uncorrected misstatements, no disagreements. So congratulations again to the team, and thank you, Mandy and Liz, for your thorough presentation. So with that, let's go ahead and move to item number 5, the SLAY report presentation. I believe we have Rebecca Franklin, who's the Director of Enterprise Risk Management and Compliance. She's here to update us on the development of the biannual SLAY report.
Good morning, Committee Chair Sotelo and committee members. As the chair said, my name is Rebecca Franklin. I'm the Director of Enterprise Risk Management and Compliance for CalHFA. I'm here to talk about the State Leadership Accountability Act, also known as the SLAY report. It is a report that's done every odd year and is submitted to our partners at the Department of Finance in California. It's a mandated report. To go to the next slide, the SLAY report is a enterprise-wide risk assessment, but it's more than just the risk assessment. It's kind of an accounting of our control environment as the agency, also kind of the different we highlight the top risks of the agency, and then we also are looking at the control effectiveness. So what are we doing to ensure that those risks don't prohibit us from achieving our strategic and business goals? The control environment itself, we kind of account for the different committees and the way CalHFA is set up and the way we decide to appropriately manage risk. And so as the Director of Risk and Compliance for the agency and for this board, I am here to provide you assurance that not only are our top risks being mitigated to an appropriate level as set forth by the risk appetite of this board, but as well as our control environment is strong and we're constantly kind of evolving that. So if we want to go into the process of SLAY itself, that is on the next slide. So the process for SLAY is we do a risk assessment, which starts with a survey. So we survey not only the executive level leaders, but also going into more of our operational leaders. It's a completely anonymous survey. So the leaders are able to kind of share their thoughts around, again, those elements that are present in our business that would prevent us from achieving our goal, both internally and externally. So we want to look at things that, are affecting us outside of CalHFA's walls. And, I always try to really enforce this with the teams is that we may not be able to control the risk occurrence, right? The market, we don't control the market. We don't control the interest rates. I'm pretty sure Erwin would like to, but he has not been able to be successful at that yet. So we need to then deploy. So we may not control the risk itself occurring, but we can control our response, the mitigating efforts that we do, and how we are able to kind of adjust as those risks grow or adjust accordingly. So once we've done the survey, we compile the results, we identify the top risks, and we meet actually as an entire senior leadership team, and we really talk about it end to end. What are we seeing? What are the trends? Ms. Johnson Hall is really promoting a collaborative effort when we talk about risks. We all own the risks, we all own the mitigants, and we're all of one team kind of looking at that control environment. And that's really the strength of the control environment. Is I've worked in a few different state agencies, and risk here at CalHFA is an embedded conversation piece in all of our decision making. Their risk and looking at risk and compliance is a seat at the table, no matter what we're doing, whether it's in the programs, whether it's in IT, etc. And so that's a really great opportunity for our agency to strengthen kind of that control environment. Once we've identified the risks, we meet in cross-functional teams, like I said, and kind of gather the mitigants and the controls, and we assess those. Are they working? Are they not working? Is there anything that we have planned strengthen them. My team then develops a report, which I will, and we submit to the Department of Finance before December 31st of every odd year. It's due on the 31st, but we all know that the thing needs to be done in the early December due to the other things that go on at the end of December. So we then will produce that report, the full report, to the board as an informational item in Q1, usually of the next calendar year, so in 2024. So that's the process that we've undertaken this year to prepare for the report. I'm going to share with you the results of the analysis that we've done and the anticipated risks that we want to report for this cycle. If you go to the next slide, comparing to from last time we did the report, which was 2021, to this year, the risks themselves haven't changed. But I don't know if anyone can see the slide. Okay. The risks themselves have kind of morphed a little bit, and then the priority has changed. So the overall risks haven't changed. The top priorities, the top risks of the agency. In 2021, we had a kind of an internal staffing workforce development risk. That risk was really focused on training, succession planning, knowledge, and competence of the team. This now, going out of the pandemic, understanding we're getting in more to a hybrid workforce, we are transitioning more to workforce development in a larger category. And then talent acquisition actually has come up. Recruiting the right people with the right skill sets, asset management, housing. They're very, very specific skill sets that we need in order to complete our team. So we've kind of morphed the risk a little bit, but it is a number one priority for the agency. The risks that flipped were the economic volatility and the data security. Economic volatility, obviously, from the middle of the pandemic or in 21 to now, the market has changed dramatically. It's continuing to change, and that has a direct impact to our business lines. And then data security. I'm not going to go super into data security because actually next month you will have our Chief Information Officer and our Chief Information Security Officer doing a more in-depth presentation on our data security. But those are kind of the three risks in 2023 we want to propose for the committee. At this time, I'm going to kind of ask for any questions that you may have or anything you'd like me to elaborate on.
Thank you very much, Rebecca. Patrick or Fred, do you guys have any questions with regard to the process or the risk?
Yeah, the risks all seem the same. Data security clearly is something that we're all dealing with. I guess we'll hear more about that. Economic oversight, economic volatility, I got to imagine those are relatively the same.
They are.
Maybe I'm missing on workforce development and talent acquisition. Is it because of the pandemic, the state's having a hard time hiring people? Is that the difference between 2023 versus 2021?
Yeah, I think we're all familiar. A lot of state agencies have very high vacancy rates right now, filling in those analysts, those journey level positions. We're not like anyone else that's not struggling in that. I think also we want to take it up a notch in that the workforce development coming from, all in the office all the time for the most part to as hybrid or as telework heavy as we could, now going into a hybrid. Actually, the executive team at CalHFA was very progressive and had a really good foresight. And once we originally knew that telework was going to be the response to the pandemic, they immediately enacted a permanent telework policy and schedule. And so we've actually had a permanent one in place for years now. And so that's a really great, kind of foresight that the CalHFA team had. But yeah, it's really getting the people in, hiring them. That's a struggle. It's not a unique struggle to CalHFA, to be honest. It's a struggle I know a lot of agencies and departments are having. And then looking at that, how do we manage, we recognize that our teams want to have collaborative opportunities to, and, kind of that social aspect, there is work-life balance, but they also want to feel like a team again. They want to have events. So, looking at that workforce development, engagement, also ensuring that we are being efficient and good stewards of funds when we're staffing, what we're staffing, where we're staffing, kind of building out programs. If you look at the strategic plan, we have a lot of new initiatives around innovative new products. Well, that takes staffing. So how do we, make sure that we're getting there?
So vacancy rate isn't an issue. It hasn't grown exponentially. There's not an issue there.
I mean, we have, I wouldn't say at an enterprise level, it's not a concern. It's not it's something that we're watching. I would say it's an emerging issue is how I'm going to categorize it for you. Where we are able to operate, we're not at a red risk level where we're there, but we do have areas in the agency where we need to, focus on in getting hiring. I think we immediately took action when we did see one program, having a little bit higher turnover than we would like. And I think all of those vacancies actually have been filled at this moment. But we want to make sure that we're looking at why people are leaving, what's happening, making sure that we're being smart about our hiring the right people in the right place. I'm a big proponent of, you got to be on the bus in the right seat. Are you in the right bus? And also, making sure that we're training those people and getting kind of, them up to speed on our practices and procedures.
Great. Fred, do you have any questions for Rebecca? No?
Hopefully this isn't a too involved question, but in terms of economic volatility, how does that relate to our the prior presentation with our accountants in terms of the new loan production? It seemed like there was a dip there.
Yeah.
How's that?
So that risk is a risk is anything that impedes us from getting our goal or achieving our goals, both from a business sense, from a strategic sense. So that has a direct correlation, right? The market, the interest rates, the availability of affordable homes in this state, that volatility does have a direct effect on our ability to produce units and provide homes, especially the single family homes in that space. It also, the market volatility around scarcity of resources, the cost of construction, that has a direct effect on our ability in the multifamily space. So we identify that obviously as a top risk. It's the top influencer on whether we're going to be able to achieve what we consider our mission, or actually achieve our core mission and vision, right? To produce housing for Californians, affordable housing for Californians. So, we do outline that. So, that is something, like I said, I want to reiterate that risks occurring, we may not have any influence on that. The price of lumber, again, I'd like to have a crystal ball and be able to forecast that. I can't. But what we can do is mitigate it, understand, and the flexibility and the agility that this team demonstrates on a daily basis is really our best mitigant, that we're able to be nimble as we can in the marketplace. We're able to just, evaluate our programs, make changes to our term sheets, do different offerings. That's the way that we really truly mitigate that market volatility and be able to. Dream for All is a very progressive new offering to the state. I mean, that, and it's not brand new. I know there's other shared appreciations, but, our ability to work with our counterparts in the government and come up with great ideas and execute them in a quite short period of time, that's a way that we can mitigate economic volatility. So, celebrating the team, we talk about the successes, we have support from the Treasurer's Office, obviously on Dream for All, but we were able to execute that go to market, and now we're going to be able to go to market again within the next, twice in the 24-month period. That's pretty progressive for a state agency to be able to deploy products like that. So the other thing is the quality of your executive team. When we met with the rating agencies, one of the major factors of our upgrade was the fact that we are practitioners here at CalHFA, that we have expertise coming to the table. Starting from the very top, Ms. Johnson Hall as, a great leader, but she also knows the business. She knows the people. Kate Ferguson and multifamily, she's just, her knowledge is just, I honestly, I don't know why I just got goosebumps when I thought about it. She's just a great resource. Ellen Martin, Erwin Tam. I mean, these are people that know the business that they are running and bring that to the table. And the rating agency actually called that out specifically in our upgrades. So, you have a very, very well, a fully staffed, fully almost, I think there's one position, executive team of practitioners that know their business. And, that's a really great asset to have. And that is a strong mitigant for that kind of economic volatility as well.
And on that note, Rebecca, that's a very positive note, and we have 3 minutes to our next board meeting. So thank you very much, Rebecca, for your presentation. We really do appreciate it. Let me move to item number 6 to see if there's any other committee matters that we'd like to address at this time. Ms.
I don't have
Fred,
anything.
Patrick, okay.
Oh, I'm good. Thank you.
Wonderful. Okay, so with that, Melissa, do we have any public comment cards or any hands raised?
If anyone's interested in making a public comment at this time, please raise your hand and we'll call upon you. I do not see any hands raised this time.
Wonderful. Okay, well, I just want to thank everyone for their patience in starting late and their participation in today's meeting. We will be reporting back to the general board meeting. So Patrick and Fred, if you have anything to add during my chair report, please feel free to let me know. But with that, let's go ahead and I'll consider a motion to adjourn.
Move to adjourn.
Okay, wonderful. So no objections. Let's go ahead and adjourn. Thank you very much, everyone, and see you in
So-
2 minutes.
If I might add, we will be continuing on with the CalHFA General Board meeting shortly, so you can stay on and continue to join us for that meeting. Thank you.